Hi, I'm Jim Jubak, and welcome to this week's Trend of the Week video. This week's topic is sticker shock. Something about inflation that makes inflation feel worse even than when it's really bad. And there's something about the way the economy is working right now and the way that social isolation and the fact that we're not getting around very much anymore also makes inflation seem a lot worse. So I was watching TV the other day. I was seeing an ad for Jeep Cherokee. They did something they should never do in a car ad. They put up the manufacturer's suggested retail price for the car, $62,000. And I went, what? The last time I looked, cars were $23,000. Well, the last time I looked was a long, long time ago. It's because I'm living in a bubble. So I've got sticker shock. Companies that are on the good side of this because they've got the ability to raise prices and not have customers run screaming out the door are companies like Chipotle, which is why I added CMG to my portfolios recently. But you've also got companies like Cummins, which makes diesel and other kinds of truck engines. They basically did earnings recently and said, hey, we're getting hammered by inflation and we're not trying not to pass on the costs. So what you're seeing here is this is a stock that's really been pretty much hammered recently twice by inflation fears, and I think that's going to continue until inflation is under control or Cummins says, hey, we're passing costs along and customers aren't running away. And let's look at a chart for Deere. Now you notice this doesn't show the same pattern, and one of the reasons for that is that Deere has been able to pass on the costs. It's not without having customers run out the door, but it's also facing a customer revolt from farmers who are basically saying, hey, you're also sort of slipping in a extra price increase because you're making your equipment less repairable, so that we've got to use Deere dealers to get it fixed, and that's going to cost us more money. The other thing about inflation is that we should look at is the way in which it has different impacts on different levels of pricing in the market. So there's a UK economics researcher trying to push for something called the Vimes index. And what the researcher is pointing out is that if you buy cheap goods because you can't afford more expensive goods, they tend not to last as long. Prices are disturbingly disguised. And the anecdote she uses from I don't remember what Discworld novel it is, I've read them all, is Sam Vines, who's a police captain, talking about the fact that poor people can't afford good boots in his world of Ankmore pork, sell for $150. His salary is $38 a month. He can't afford good boots, so he buys cheap boots. Good boots would last for 10 years. Cheap boots last for less than a year. They're made out of cardboard. They're not really made out of wood leather soles. And he points out that in the 10 years that you would have your good boots, a poor person buying $28 boots that last less than a year would pay about $280 for that $150 pair of purchase. You're doing a lot of purchasing. If you've got a good pair of boots, you can put off that purchase until inflation comes down. If you've got a bad pair of boots, cheap boots, you got to buy them now. Inflation has a bigger impact. So when we talk about inflation, we've got to remember, we've got these expectation lags. We've got sticker shock. We've got is operating at different levels in the price system, and all that is really leading into one phenomenon that we call inflation. Thanks for watching. It's been Jim Jubak. If you like this video, give it a thumbs up. Please subscribe to my YouTube channel. That way you get more notification when we do another one of these. If you want to see more of my stuff, you can go online to my jubakpicks.com free site. 3 portfolios, lots of stock picks, or 6 portfolios on my subscription site, jubakam.com. Also stuff about ETFs and options. Thanks very much for watching.